Hello and welcome back to another episode of Financial Fix with Sharnella. And today I have a mortgage expert with us. Her name is Christina
Gortzen.
Yeah, it's a German name, right?
Yes. Thank you so much for having me.
Yeah, so there's a lot of myths out there and there's a lot of misinformation. And today Christina is going to clear up some of that misinformation and myths for us. So I know that I know a little bit about mortgages because I myself own a home. But it's been a while since I've purchased my home. And so things change all the time in the industry. And so we need updated information.
Of course.
But a lot of us out there, we don't know what questions to ask, right? You don't know what you don't know. So sometimes it's like, well, I want to own a home. I really don't know what I need to do to put myself in a position to own a home, but I don't quite know the questions to ask. So Christina's going to clear it up for us, and she's going to let us know, if you're a first-time home buyer, what you need to do to qualify for a mortgage.
Yeah. So typically when somebody goes to qualify for a home, and there are exceptions, we're going to dive into that, but you need about 3% down for the down payment. With conventional. With FHA, you need 3.5% down.
Really?
That's for the 3% down of the purchase price. And then for FHA, we only need a 580 credit score. For conventional, it's 620. And then we just need 2 years of employment history.
Okay.
So if you're W-2, we need your most recent pay stub, and then 2 years tax returns. If you're 1099, it can vary. Typically, it's about 2 years, but in some cases, it might need to be 5 years. So if you bounce around from 1099 to 1099, and then there are exceptions. I have a client right now, she has no credit score and she's in the process of purchasing a home. Or if there's down payment assistance. So if you don't have that 3 to 3.5% down as a first time home buyer, there's a lot of programs out there for you.
And that's FHA, right? The FHA will help with down payment assistance, or is that conventional also?
So most of the down payment assistance is through FHA. However, there's called a 1% down program with conventional. Those ones are a little bit more strict to qualify, but if you do qualify, they will give you 2% credit towards closing costs.
Oh, that's pretty darn good.
For the down payment.
And for people that don't know, closing costs, that typically entails prepaid taxes that you have to reimburse the seller. There's
the insurance,
and then there's a title fee, and then the cost for the loan, right?
Yep, the appraisal, the credit report, all of those fees wrapped into one are about 2 to 3% of the purchase price. Okay. So typically you would be the one paying for it, but there are other ways around it. We can negotiate the seller paying for a portion of the closing costs, or there's down payment assistance as well.
Okay. Okay, wonderful. And are there some, I guess I'm kind of thinking of a different type of, I'm thinking about a refi where you can roll your closing costs into the loan. You can't do that with traditional.
With USDA, which I call those farm loans, they're typically agricultural loans. You can roll in a good portion of closing costs into the loan. Typically it's about 2%, so not all of it, but most of it.
Okay.
Then if you, if you don't plan on being in the home for very long and you don't care what the interest rate is, we can give you a higher interest rate, which will give you a credit towards closing costs.
Oh, wow. Wow. So it seems like there's a lot of flexibility today, right now.
Yes, in this day and age, loans can be customized to fit your needs 100%. It's no longer a one-size-fits-all type of thing. It's if you need something to be changed or tweaked or pretty much anything, all loans are customizable these days.
Okay, wonderful. So let's kind of pretend here that I am coming to you.
Okay.
And Christina, I want to purchase a home, but say my credit score right now is pretty low. What can I do to put myself in a position where I can qualify for a loan? And I think you said with FHA it's 580, is that correct?
580, correct.
Okay, so say I have a credit score of 540.
540?
Yeah.
Okay, so I have what's called a credit simulator. So I do a little bit of credit repair. But before we get into any of that, there's 2 things I like to do. Is one, make sure you're monitoring your credit.
Okay.
That way, if there's anything on there, anything that's false, so if there's any like late payments on there that are reporting late, but you know you paid, it might be something on the creditor. So maybe they messed up and it's reporting false on your credit. So I check your credit for accuracies, and then we want to be monitoring your credit as well, because we can't fix your credit if you don't know what it is.
Exactly.
And then from there, then I take a look at what are you doing good, what are you doing bad. Let's say you're making all of your payments on time, but you have a credit card maxed out every single month. That's going to be considered high risk.
Yeah,
So
for
from-
sure.
Yeah, so from there I come up with a game plan to tweak what you're already doing. I'm going to say, hey, you're doing this, that's great, but let's kind of utilize your spending to be under that 30% mark. And if you're in a hurry, Experian classifies anything under 7% utilization as excellent.
Right.
So I would keep it between that 1% and 7% mark.
So in other words, because I understand this pretty well with credit, but for the viewers, when we talk about utilization being under 30%, that is, if you have a credit limit of say $10,000, then you only want to spend about 30% of that $10,000 credit. So you want to keep it like around maybe $3,000, if you have a $10,000 credit line. So,
and I get into that a little bit deeper, right? Because people want to know details. So anything above 30% is pretty much looked at as high.
okay.
But if you're in a hurry or if you want to be in that excellent ranking, I say 7%.
Oh, wow.
Experian, and if you go on the app, it's kind of hard to find, but they have a lot of educational blogs on there,
Okay.
directly through the Credit Bureau's app. They dictate anything at 7% or lower as excellent. So if you
Wow.
want to be in that 800 club, shoot to have it at 7% or lower.
Okay.
It's very simple. Step one, just know what your credit limit is. Because if you don't know what your credit limit is, there's no way you're going to know
exactly.
if you're at the right utilization.
Yeah.
So let's say you're at $1,000. I would say to keep it at that $70 mark or lower.
Okay. Okay. Wow, that's great. That's great to know.
Yeah.
So again, we don't know all the questions to ask. So
Yeah.
credit score is obvious. What are the other things that we need to pay attention to when we are in the process of applying for a mortgage?
So, checking everything for accuracies. That's a big thing I like to look into.
Like
the
your
first-
credit report, right?
Your credit report. So the first thing I ask people is, hey, do you have an idea of what your credit score is? You might tell me, yeah, my banking app says it's 720.
Okay.
I'm going to say, is your banking app using your Vantage score or your FICO score?
Oh, what's the difference?
This is the biggest misconception I see out there.
Okay.
So over 90% of all financing nationwide uses the FICO model.
Okay.
So when you're looking at your credit score, it's going to say in teeny tiny little print on the center, either Vantage or FICO. So sometimes you might look at your credit score on whatever credit monitoring service you're using, and you might think your credit is excellent. Then when we go to pull your credit, it's 100 points lower.
Wow.
I see this all the time, and people are like, but I thought it was so great. My credit monitoring service says it's 700s, but now you're saying it's in the 600s. It's because it's two separate credit models. And that is something, it confuses a lot of consumers. I'd say like 50% of first-time home buyers come to me, and I educate them on this. And that detail in and of itself has been able to like help people like accurately monitor their credit.
Okay.
And it just sets them up for success long term. My favorite one, no, I'm not sponsored by it, is Experian.
Okay.
That is the only free credit monitoring service that will show you your FICO score, which is your real credit score when you go to apply for a loan.
Okay. So I know that on my credit card app, it shows my FICO score. Is that pretty accurate?
As long as it says FICO. If you look, when you go to actually click on your credit report, it'll show the little red, yellow, green arrow with the number in the middle. And at the very bottom, right underneath the number, it'll either say Vantage or it'll say FICO. If it says FICO, you're good. If it says Vantage, it's not that it's not your credit score, but it's a completely separate credit model. So when purchasing a home, it's basically irrelevant.
Oh, wow.
So
That's
that
good to
is the number one biggest misconception I see out there.
Okay. Now, some of my viewers, like myself, they might be investors, so they may not have a W-2. What are some of the hurdles that a person owning a business, working for themselves, might face?
So there's two things I like to look at. If you're self-employed, meaning you have an LLC, you pretty much have all of the pros and cons to being a business owner.
Okay.
And if you're just a 1099, I urge everyone who is 1099 to get an LLC. Reason being, I had a client right now. They were 1099 for 5 years. So in the eyes of mortgages, we will look at 1099 as self-employed. However, if you're bouncing around different employers, I now need to reset that clock of having at least 1 year of experience with that 1099 income versus if you were to have an LLC, and that would report as, it just files differently so that you have that stability.
Okay.
So if you have an LLC, we just need to show that you've had that LLC for at least 2 years or 1 year of the LLC with 5 years of experience in that industry.
Okay.
So let's say let's say you were a painter for a painting company and you were W-2. Then you decide to file an LLC, start your own painting business. You've been in this industry for multiple years, therefore the lender's going to look at you as low risk.
Okay.
So that when you go to apply for a mortgage, you're not having to file 3-4 years of taxes. You can actually qualify off of 1 year. Typically it's 2. But if you have that LLC plus that experience, then we can qualify you sooner.
Oh, wow.
The biggest mistake I see with people who are self-employed is they're afraid to file for the LLC. I have a client right now. They were working with one employer as a 1099, which is an independent contractor, and they decided to leave that employer and start with a new employer, but because of that, they no longer qualify because they don't have an LLC.
Wow.
So now they're having to file an LLC and wait a year to qualify for a mortgage.
Wow, so it doesn't matter that they're doing the same type of work, just with now a different company.
Yeah, because they don't have the LLC.
Oh, wow.
So pretty much I say if you have a 1099, so if you're an independent contractor, in the eyes of a mortgage, you have all of the cons of being a business owner without any of the perks.
Oh, wow.
So if you're an independent contractor, get your LLC.
Oh, wow.
If you go to your tax person, it's maybe $200-$300. Don't quote me on that, but pretty affordable to file for an LLC. And
actually, it's really easy. You can do it yourself.
Really?
I have several LLCs.
Yeah.
And I have never hired an attorney or anyone else to do it. Here in Michigan, it's very simple, but if you're viewing from a different state, you'll definitely want to check into your state's guidelines. But for Michigan, you just go to the LARA website, and actually there's a phone number that you can call that we will present to you at the end of this video. That will, you can actually call that number and they will walk you through applying for the LLC step by step. So it's really not that difficult.
See, I didn't know that.
Yeah, and in the end, it only costs $50.
Oh wow!
And then every year when you renew, it's just $25. So
See,
it's
I
really
didn't
not
know
that
that.
difficult. It really isn't.
Yeah, I always just advise people to reach out to their tax person. That's out of my lane, but and that's another thing. If you're wanting to purchase a home, but maybe it's next year, it's not in the short-term future. The smartest thing you can do, especially if you're self-employed, is to get your mortgage person or broker teamed up with your tax advisor so that we can strategize together where you still qualify for a home, but where we can strategize, like say you want to have certain write-offs and you have expenses so that you benefit from having a tax advisor help you out tax-wise with still qualifying for a mortgage.
Wow, yeah, that's excellent. So is there anything else that maybe, we just haven't thought to ask as far as...
There's such a thing as no credit qualifying.
Oh, okay. Wow. No credit.
No credit. So,
so one question.
Yes.
Is no credit just as bad as having bad credit?
No.
Oh.
No credit is just it's like you're a baby. Like, you
Okay.
know, there's nothing bad, there's nothing good. It's
Right.
just life.
We don't know you.
Exactly. So you haven't made any mistakes, but you also haven't done anything right.
Right.
No credit is 100% better than bad credit because
Okay.
we're not having to fix anything. We just need to establish something. So we have what's called trade lines. And for example, if you've lived at an apartment for at least a year, we can establish a trade line. So we can cosmetically report that on your credit report. You're still not going to have a credit score, but that does establish lower risk, and lenders will use trade lines to qualify you manually instead of the traditional route. So I have a client right now, she had 1 year of renting, she had 1 year of utilities, so with DTE, and then she had a year of a cell phone bill. I've even seen it where somebody was able to use a PlayStation subscription and a Netflix account.
Really?
Anything with 12 months of payment history
Yes.
we can use as a trade line. So biggest kicker is you just need 1 year of rent and then 2 trade lines. So even if it's a Hulu or a Netflix subscription, we can use it.
Wow. And I think also Experian has this Boost program where you can report your utility bills. If you pay your utilities on time, you know, they can use that as well. As a way
that would be considered a positive trade line.
Okay.
Yeah.
Wonderful.
So when we go the traditional route, it doesn't really make a difference one way or another. But if you're having to go with a manual underwrite, which basically just means your approval is based on a physical person reviewing your file instead of a software.
Okay.
And that's the only difference between an AUS approval versus, or an automated approval versus a manual underwrite.
Right. Okay. So automated would be someone with a great credit score, and you just input the information into this automated system, and they automatically decides if the person is eligible for.
Yeah, and it's pretty simple. We take your file, we put it in, we hit a button to run it. It's called AUS, and then it'll either turn green and say approved, which yay, or it'll say caution.
Okay.
And then we have to get to restructuring. But another way is through a manual underwrite. Obviously, the automated approval is a little bit more ideal. Interest rates tend to be a little bit better. But if you don't qualify, like for example, if you have no credit, manual underwrite is a great option.
Okay. And for those young people who are just graduating college and, you know, they may be focusing on paying down debt and maybe they're staying at home and they're saving.
Yeah.
One thing I did as a young person was I went to my bank and I opened up a credit card with a very low credit
limit?
Credit limit.
Yeah.
And so over time, I began to build confidence with that bank, and I established my credit that way.
Yeah.
So that's for people who are just starting out. Now, for people with bad credit, how do they best go about repairing that credit?
Yeah, so again, the first thing I'd say is know where you currently are, right? So a lot of times people aren't in as bad a position as they think they are,
Right.
or there might be something on there that's not accurate. So I had one client, they had a creditor, so they had a credit card, right? And then not super familiar, but I understand there's upgraded credit cards, like the Platinum Perks. So they closed one, and then they got the new shiny credit card, right? So that account was completely closed, and then they had the new credit card. Everything's good, so they thought. The creditor, and I won't say any names, was falsely reporting that they had late payments on this closed credit card account because of the annual fee, and they had 90, 120 rolling lates on their credit score.
Oh my gosh.
Yep. So over 90 different lates on their credit report, and their credit was all the way in the 400s. So the very first thing we did is I had them download their free credit report, which that's another thing. Everybody nationwide is entitled to at least one free credit report per year. You can reach out to either of us and we can tell you a little bit how that works, and you can send it to us. We'll review it with you. And then if you have something on there, such as like disputes that are 90 reporting leads, which is just blows my mind.
And this person did nothing wrong.
They had no idea it was even there. They felt very defeated. They didn't understand why their credit was so bad. To their knowledge, they only had 2 late payments, and they thought that their credit was in the 400s because of 2 late payments.
Wow. No.
But really, it's all of these late payments that they had no idea about. So when I brought it to their attention, they said, "No, we have no idea what this is." They thought were a victim of identity theft.
Okay.
And it was all because the creditor was reporting it incorrectly.
Wow.
So it did take a little bit of time. It took almost 3 months to get that fixed and resolved. We were getting a little bit of pushback from the creditor.
Wow.
But once we were able to get that taken care of and removed and disputed it with the credit company, it boosted their credit 120 points.
Wow.
At no cost to anybody.
Wow.
So a lot of people think that you have to spend all this money to fix their credit, but if it's something as simple as just fixing accuracies, that can boost your credit a lot.
Yeah.
So that would be step 1, is know what your credit truly is, get your credit report, and again, you can reach out to either of us on where to get your free credit report, and then we can review it for accuracies.
Yes.
So that's always step 1.
Okay.
Yeah.
Wow. That's pretty interesting.
That one blew me away. The fact that they had no idea, and it was very rewarding to help them out.
Yeah.
Because they had no knowledge of it, and they were, for the most part, they were doing everything right. They had 2 late payments within the past 2 years,
Right. Which still happens every now and then.
Yeah.
I mean, I get busy myself, and it's not that I don't have the money in my bank account. It's just that you get busy, you set the bill down on the office desk, and it's like, oh shoot, the bill was due 2 days ago. But now I just put my bills on auto pay because it's so much easier for me. You know, I pay my credit card off every month in full, so it's just easy to just set up an auto pay to pay it off every month in full, set it and leave it, and then you never have to remember to pay your credit cards on time. I do that with my mortgage. I do that with all of my utilities as well. So I thank you so much. Now, is there anything else that maybe I myself forgot to ask that you think maybe the consumer needs to know?
So for you and me, this might seem obvious, but I mainly see this with younger people who like to spend a little bit out of their means. I hear a lot of people say that, ooh, buying a new car, big flashy car, it helps fix my credit.
Oh, no, it does not. It's just the opposite.
Yes, and it is one of the biggest mistakes I see people make. You and I know you only need a credit card with, say, $1,000 limit. Or even, I have one with $1,000 limit. I spend $20 a month tops on that credit card. I'm proud to say I'm in the 800 club.
Me too.
So with my credit card, again, I spend $20 a month. That's I gas up on it. That's it. So my heart breaks when I hear people say, "Oh, I got this big flashy car because it helps fix my credit." I'm like, you're spending so much money. I'll give you an example. I met a guy, and he thought that homeownership was completely out of reach, and he made excellent money. And I'm like, how are you thinking that homeownership is out of reach for you? You make great money. He's like, I have this and this and this to pay. And then I realized, I'm like, he has 2 car payments. He had a big flashy car that he couldn't drive in the winter. So then he also needed a nice pickup truck so that he could drive in the winter. I did the math. I'm like, how much is your car payment? How much are you paying in insurance? Did the math, and then I showed him my mortgage statement. I'm like, do you realize you are paying more in your car payments than I pay in my mortgage?
Exactly. It's ridiculous.
Yes, and that is the number one biggest mistake I see people make, is just getting a car, big flashy car, before the house.
Exactly.
Obviously, we all want the big flashy car, but you can't live in it.
No.
It kills people's qualifying ability and purchase power, and that's probably the biggest mistake I see people make.
And also remember, a car is a depreciating asset. Those are not the assets that you really want to focus on. Home ownership over time, historically, is one of the best investments that you can make that's going to increase your net worth.
Yep.
You know, it's going to increase your wealth over time.
Of course.
And so I really would like for people to reconsider, like she said, purchasing the flashy vehicles. Myself personally, I always buy used. I haven't bought a brand new car since maybe 2010 because I realized that it just wasn't a good value. It wasn't worth it. The moment you drive it off the lot, you're losing anywhere between 10 and 12%. So a good used car that works just fine is perfect.
A little bit humbling.
Yeah.
But usually the smarter financial decision is the more humble one. But that is definitely the number one biggest mistake I see people make. Just because at the end of the day, you can't live in that car.
No.
So buy the house first. Once you have the house, you have everything that you need to live in and are a homeowner, then you can take a look at buying the big flashy car.
Because like she said, you know, with all the income that this guy was spending, 2 car notes, 2 insurance bills, that really put him in a position where he then couldn't afford a mortgage. So thank you so much, Christina.
Yeah,
I mean,
thank you
this
for
has
having
been very informational and actually quite fun just listening to you talk about the
And
fact
I learned from you too about
Yeah.
LLC.
Yeah, because you know what, there's a lot of people out there who you really do qualify for a mortgage, you just don't know it. And if you're here in Michigan, we definitely want you to reach out to Christina. Can you please provide your email address and any contact information for my viewers?
Yeah, my email address is Christina@experthomelending, CRISTINA XPERTHOMELENDING. Both spelled a little bit different. My social medias, I have an Instagram, Mortgage by Christina. TikTok is Credit by Christina, and Facebook is Christina Gordson, Mortgage Loan Officer.
Okay, wonderful. And for my viewers out there, you're watching Financial Fix with Sharnella. And of course, I have Facebook, which is simply Sharnella Clark. And my Instagram is also Sharnella Clark. And I give financial tips and I help people, again, create a plan, a budget to get out of debt. Save, invest, purchase a home. And I know that lately in social media, I've been hearing a lot of people steer young people away from home ownership. And I think that is probably the wrong message that you're trying to send to the young people. If you buy a home right, if you buy in a good upcoming neighborhood, one where the home values are increasing, where that community is growing, you almost can't go wrong, you know. So I want you to continue watching my channel, and because I'm going to always have some information here that maybe you didn't know before. Thank you for watching Financial Fix with Sharnella, and I will see you on the next episode.